Welcome in. This is Joe Cucchiara with Real Estate Radio Live, the podcast version. Thank you again for joining us in our series as we move forward. Just a reminder, a couple different ways you could reach me. One is reradiolive.com. Also the phone number, 408-838-9060. Before we get started, too, just a reminder, I'm here to help you with any financing needed, purchase, refinances, restructuring at all. If you have any questions, you could reach out and give me a call at 408-838-9060. Also, be sure to remember that if you're in need of business partners in terms of financial planners, CPAs, real estate agents, legal advice, anything around real estate or helping you with your real estate needs or financing needs, always contact me, and I have those referrals for you. All right, let me invite in my guest, Mr. Ron Howard. He is no stranger to the show. He's been with us for the last couple of years on and off. He is with Siena Wealth Management. Welcome in, Ron. Good to have you back.
Always good to be here, Joe.
Always good. We're going to cover a number of different topics here. We're going to roll into kind of finish in 2016. Ron is always good at giving us an update on what's going on in the markets. And, of course, we'll talk about the elections. What would a good discussion be without the elections? And much, much more. And always, Ron, I know you're good about giving the book away. Why don't we, again, let those listeners know via podcast that if they'd like a copy of the book that you wrote a forward with, you could always call in or email, and it's The Wealth Solution. It's a book, a great book that Ron has wrote the forward to, and he's always good enough to give a copy out for those interested. So if you're listening to the podcast, if you want to email me, Joe at reradiolive.com, or contact us via the website, we'll be happy to get one of those books to you with that information. All right, maybe we get started, Ron. Tell us a little bit about your background and current roles and responsibilities with Siena Wealth Management.
Good to be here again, Joe. Yes,
yeah.
I'm managing principal of Siena Wealth Management. It's an independent investment advisor located here in San Jose. And I've been in the business for 35 years, working with clients, helping them build their wealth, helping them invest for their retirement, helping them with protect their wealth and minimize taxes and cover that whole gamut of wealth solutions for clients. But probably the greatest thrill is to get people to start saving.
Yeah.
Start saving and setting aside and preparing, because if you can do that and get that momentum going,
right,
you get enthusiastic about retiring. I had a client come in who was in his 50s yesterday. He was, basically an owner of his own construction company, had nothing set aside to speak of, and we finally got him his first $100,000 in there. Now he's excited about putting more in there, and that's what you want to have to build towards that future. So we just love working with clients to helping them meet their financial goals. Yeah,
and I know that you're an advocate, of course, of the sooner the better, right? I mean, we could talk about that another time too. How important it is for the young kids these days to understand just the power of investing and compounding interest, and it's so powerful, and the earlier the better, for sure.
I think in our last show we talked about the little book pamphlet called "The Richest Man in
Babylon." Yeah,
and just talks about setting aside 10% of whatever you earn and letting that grow, and it's amazing how that can compound and create big results.
Yeah. Very powerful. Well, let's talk a little bit about the market. We're wrapping up 2016. Gosh, as we do the podcast here, we're rolling into December. Were there any things that were a surprise to you? How would you kind of phrase the market and talk a little bit about, if you will, how 2016 shaped up? Any surprises, any expectations, or how do you see that?
I wrote here in my little notes, the election surprise.
There was that little election, too.
That was so amazing. I mean, being here in California and the news had all forecasted and the markets all expected for Hillary to win.
Yeah.
And so I remember the day of Election Day, I said to one of my other advisors in the firm, I said, well, if by chance, Trump wins, what's going to happen to the market? Oh, the market will be down 2,000 or 3,000 points the next day. I thought, well, I'm not sure it'll be down that much, maybe 800 points. Yeah. And so then you go to the election, and results happen. At 1 or 2 in the morning, they mentioned that the Dow future had dropped 800 points.
Did you? I saw that as I was watching the elections. I was so engaged and enthralled in that. I was watching, and then they were, of course, doing the futures, right?
Yeah,
or
the futures were down before the market even opened up. Right. I go, oh, man, I better get up early and get down to the office there. Clients will be calling. And so anyway, get up at 5. The market opens up positive. I go, what in the world happened from an 800-point deficit down to now it's up 30 or 40 points? And I think almost, except for a few days, every day we've had an increase. in the market. I mean, talk about a surprise. I had a little analysis since Election Day, which would be the 8th of November, until now, which is we're now November 30th. So that 3 weeks time, we're up 4.78% on the Dow.
Wow.
Yeah, the Dow's up 4.78%. So that's almost 5% in 3 weeks. And before that, we were a little bit ahead, for the year. But the year kind of 2016 was a volatile year. The first part of the year was negative. We still had the overhang of oil and China and uncertainty, and the list goes on about all this uncertainty in the market with consumer confidence, with inflation. And so it wasn't until the fall time we actually started seeing some returns. Yeah.
Isn't this just another example as we're talking, I'm listening, and, another reason why when you start investing, working with the people you should work with that you trust, but just stay on track and just invest and do it religiously and over and over and over again. I guess what I'm saying is we don't know what's going to happen with these elections. No. We don't know how people are going to react. The media got it wrong. The people got it wrong what was going to happen if Trump were elected or not elected, right? And so I guess it reminds me, as we talk about all the time and you advocate as well, just put your strategy together for yourself, your family, your business, whatever it is. And whatever happens, happens, but you can only control your own destiny in that sense, right?
Yeah. In fact, I wrote down here dollar cost averaging, which,
there you go.
Which is what you just talked about,
Yeah.
And that's just depending on where you are in your life. Now, obviously, if you're retired, it's hard to set money aside because now we're taking money out of your portfolios to provide for, your cash flow.
Right.
But if you're working, you want to set money aside, regularly, whether it's every month.
Right.
Whether it's twice a month, whether it's once a quarter, you want to be able to set aside money and have it just go in, whether the market's up or whether it's down. If the market's down and you're putting money in, you're buying more shares at the same money you're putting in, so because the prices have come down, so you're buying a little more. If the market goes up, that's good because the markets have gone up, your values have gone up, but you don't get as much, but you just keep doing that on a regular basis.
Yeah.
That's that dollar cost average. And then what happens, we bring in this word called compounding.
Right.
And that just compounds.
Becomes very powerful.
Dividends come in, capital gains come in, the growth comes in, it just compounds to where it just keeps going.
Now, of course, the other side of this is we've seen, and I deal with this every day, we have benefited from low interest rates for I don't know how many years now. Yeah. And we also, and I've been talking to clients and sending information on a regular basis. Do what's important now and take advantage now because when they go up quickly and there's very little notice. And I think we all got used to it. We thought it was never going to change. So here we are. We had with the Trump election, I'm not sure if it had something to do with it, but then the stock market rallies a little bit more. And now we have rates up about 0.5% from where they were a month or so ago.
Yeah.
Again, it's funny to talk about, if we go from 3 5/8 to a 30-year fix, let's say to 4 and 1/8, I mean, it's still relatively good, cheap money, right?
we can remember buying houses at 9, 10, 12% interest rates. So 3 and 4%, that's a steal.
Not too bad. Not too bad. So
that goes to the point with the market, too, because surprises happen and people can't forecast. So I have clients, or especially new people come into our office that are looking at hiring us as their advisor, saying, we want you to pick and choose and time the markets. I'm going, well, if I was really a good stock picker or a fund picker or an asset class picker, or I could time the markets. I mean, I love the Silicon Valley, but I'd probably be living somewhere else if I could do that. Because if you're good at doing that, you can make lots of money. But the reality is, you might pick it once in terms of getting out, but it's getting back in. That's the problem. And I've had clients come to me and say, I think the market's going to get hammered for whatever reason, elections, or it could have been in Europe, it could be whatever problems you see. I want to go to cash. Yeah. And they go to cash, and they miss a big, huge rally that happens in the next 6 months. And so now they've missed some good days of the market. Yeah.
Well, we're about halfway through our segment here, or I should say our show. So I want to, before we jump in and take a break, quick break, the elections, kind of just to round it up and summarize, what do you think, if any, or is it too hard to tell what kind of effect it'll have going into 2017 on the Trump presidency?
Well, from all the indication I'm picking up, he's talking about the right things for growth in the U.S., and that is he's talking about taxes. Right. I mean, you have just billions of dollars camped offshore for corporations. If you can develop a holiday, lower the tax rate. I think there's bipartisan agreement, both Democrats and Republican, to lower the corporate tax rate. That brings a tremendous amount of money back into the U.S. That's going to do all kinds of things. So I think that would be a big, huge benefit. If they can come in and you can talk about taxes for across the middle income, and streamline a little bit and get that under control a little bit, that'll be a big help. If they can reduce regulations so it doesn't strangle small businesses, that's a big thing, a big boon for jobs. So if you can come back in and do a couple of those things, I think it's going to help unemployment, and I think it'll help with job increases. It'll expand the economy. You need to get a growing economy, and to be growing at a GDP of 1.5–2% is not going to cut it.
Yeah.
So you need to get that 3, 4, 5% back in there to get things moving again. So I'm optimistic. But with that, there's always volatility. So there's going to be a war happens over here. There's going to be an event that happens over here that's going to create some volatility. But again, that's just noise when it comes to your portfolio.
Right. Well, be fair, we'll give it out towards the end too, Ron. But again, if anybody listening to the podcast, they want to reach you, contact you, what's the best way to do that? Our
phone number here in San Jose is 408-244-3800. Again, 408-244-3800. You can visit our website at www.siena.wealth.com. That's Siena with just one N, like Siena, Italy.
Very good.
There's more information there, and they can get my email there as well.
All right. Again, this is Joe Cucchiara. If you're just tuning in, Real Estate Radio Live, the podcast series. I'm interviewing Ron Howard. He's with Siena Wealth Management. He's also giving away a book, so if you want more information on that, keep tuned in. We'll continue to do that. Also, if you need any information on financing, mortgages, I'm here for you, 408-408, again, 838-9060. Welcome back. It's Joe Cucchiara with Real Estate Radio Live, the podcast series. Today I'm interviewing Mr. Ron Howard with Siena Wealth Management. We're talking about the market, the election, some of the details of the election, and we're going to continue doing that. Again, if you need any information on mortgage services, financing, you need help with a real estate agent, financial planner, someone like Ron Howard, you can always contact me, 408-838-9060, or always go to our website, radiolive.com. Okay, back with Ron. I think before we move on to some of the other things we're going to cover, Ron, if you wanted to, I think, summarize some of the stuff that you provide in your newsletter, by the way. And then once you do talk about that, remind others how they could, I guess, reach you if they wanted to get a copy of this newsletter. They could do that.
Sure, we do a quarterly newsletter out to clients.
Okay.
And this last one was entitled U.S. Presidential Elections and Financial Markets. And so it's put right after the election. But irrespective of who comes into office, whether they're Republican or Democrat, there's been all kinds of research that says it's mixed. That you could have Democrats and Republicans, both could do well, both could do poor. So there's no ongoing evidence. But here's a great quote that I put in the newsletter here from a professor at the University of Chicago. He also happened to be a former chair of the President's Council for Economic Advisors for President Obama. His name is Alan Goolsbee. Okay. You see him on radio and TV as coming on. His comment was, quote, "I think the world rests too much power, certainly in the president, probably in Washington in general, for the influence on the economy, because most of the economy has nothing to do with government." End of quote. Yeah. And he goes on to say that, hey, while governments have impact, the majority of companies will adopt and advance regardless of which political party controls the Oval Office. Right. So keep that in mind. We get fixated on these elections, and it becomes a lot of noise to a certain extent. Now, there can be some things that policies and will have some effect, but corporations are adaptable, they're nimble, they're smart, they have smart people, and we want to buy their services. Right. So the market will move on irrespective of who. I
think that's well said. We chatted a little bit about it earlier, and that is, I think it comes back to that, corporations certainly do it, individuals should do it. Manage your business, your life, your individual, whatever you're doing, and stay focused on that. Certainly there's some minor things that could happen with the government that can make changes, but the smart people, the smart companies are going to adjust no matter who's in the office. Yeah. They're just going to make those adjustments, for sure.
Then I thought we'd jump over and talk about, if you miss some best days
Yeah,
of
that's
the market.
interesting statistics. Let's cover that. That's interesting. You want to go through that with us?
Yeah, so there's all kinds of research out there that if you miss, the best day of 1 year, the best day of 5 years, 10 years, or the best 6 days. And so we could spend a lot of time, but I'll kind of go through a long period of time.
And this is covered in the book that you wrote the forward with, too.
So page 95 of our book, it talks about here the effect of missing the market's best days.
Okay.
So every now and then you have this day that the market just shoots up. And if you happen to be in cash, you miss it. So they talk about here since 1970 to 2010, it's basically 40 years there. The average S&P 500 did about 10%. If you miss just one day of that period of 40 years, you got 9.7%. So you list out about 30 basis points. But if you miss, basically I'll go down here, if you miss 25 of the best days, you're down to 6.2%.
Wow, that's a big difference.
So you go from 10% down to 6.2% if you miss the best 25 days. So you never know when those 25 days are going to be. They're unknown. So that's why the power of just staying invested, which you've talked about before. There's another result from the Dow that was over a 28-year period of time that if you missed the best 10 days, a dollar goes to, instead of $13, it goes to $6.52.
Yeah.
So about half if you missed just the best 10 days over that 28-year period of time. So you just don't know when those best days are going to be, so it goes back to the point, just stay invested.
Yeah. One of the things I wanted to chat with you, I always like when you come in to talk about how real estate and real estate investments align with a person's portfolio, if you will, or their overall investing strategy. I know you're an advocate of real estate, and talk a little bit about clients you've dealt with, and what would you say if someone started asking about, gee, Ron, I'd like to diversify a little bit, maybe buy an investment property in another state or here, or a second home. What types of things do you, when a client comes to you about buying more real estate, what things are you cautious about? What things do you warn them about? And also, what do you like about that?
Yeah. So the first thing is, my dad was a real estate developer, so we had apartments. I was a kid. I can remember cleaning the apartments and mowing the lines. This is going to be a part of your college fund at some point in time, and it was. So I've been around it all my life. Yeah. And so I start talking with clients. If you've never been involved in real estate, then just be really careful because there's a lot of things that unexpected with insurance, maintenance problems. You got to take care of this and that. So make sure you have the disposition, you have the time, and you enjoy doing that kind of thing. And some people love being a handyman, fixing things up, and that's great. The second is where you're going to do it. The Bay Area is so expensive if you're going to buy. Your cap rates are low. If you have leverage in there, you have negative cash flow. So you really got to look out of state. And then it's a whole other situation where it gets exciting. You look at some tax benefits here and there, but then the reality comes that you have a property manager. People move out of your place. You beat it up. You got to spend money. I have clients who've had 5, 6, 7 properties, and now after 5 or 6, 8 years, they say, okay, it's time to time to look at other options there. So I think if you enjoy doing it, it's a great way to build your wealth. I was off the phone with a client today that's got big cash flow on a property out in Florida that he bought. And so it can work out well if you have the money to be able to do that. Yeah,
just be warned. And I agree with you. I mean, it's easy to get caught up sometimes when you hear people's stories about how easy it is in flipping properties or, acquiring properties. But I would agree there's a lot that goes along with that for sure.
The other option, too, that is a real estate investment trust. And so those are another option where you don't get involved in the day-to-day management. Now, there's two kinds. There's a non-traded REIT, which I don't recommend, and there's a traded REIT. The traded REITs are obviously liquid all the time, so there's a couple options there. The non-traded REITs can sometimes get into some troubles.
Very good. All right, well, let's talk about the Dow bar now. You have a little information you're going to share with us on that, and give us some feedback on that. And I know one of the things you need to know about Ron, obviously, if you're not here, you're not seeing it, but he is the graphs and data guru on anything and everything. And also, by the way, before I forget, too, some great stuff on your website.
Oh, yeah.
If anybody wants to do a little research, jump on the website. Yeah. You guys do a great job at just keeping people, you keep me captivated in terms of some of the stuff you have there.
We even have podcasts on that website from the famous radio live show here, Real Estate Radio 360.
So talk yet again about a little bit about the Dow bar here.
So, I always began by saying that, investors get fixated on things they see in the newspaper.
Mm-hmm.
Wall Street Journal says, this mutual fund did this, got 18% or got 21%. Everyone's reporting their returns. And the fund may have got that return. The fund will pick their date, the start date, end date, and they'll show the returns. So Dalbar is a group out of Boston that says, well, the funds may have got 21%, but what did the investor actually get? Because the investor may not come in, be that whole period of time. They may come in, they may come out. So what does the average mutual fund investor get? So they took a look at mutual funds because they have good data to report on that. So they came out recently from 1996 to 2015. They showed the S&P 500 returned 8.19%. You just put it in a stupid, dumb, blind index of the 500 companies. You don't trade. You just go out and play golf. You go out and have a good time. But you just buy those 500 companies in the S&P 500 index, and you get 8%. They then said that same exact period of time, they went out to the average mutual fund investor. The average mutual fund investor got 4.67%, about half.
Wow.
And you say, well, wait a minute. The S&P did 8% plus. The average stock investor in the fund got 4.67, and why?
Yeah, how's that happen?
How's that happen? Well, this is over a 25-year period of time here. So the answer is, goes back to our little famous Skittles chart that we talk about from time to time. Right. What happens is people don't stay invested. So they tend to buy a fund.
I see. And
the fund's doing well for a couple of years, and all of a sudden it drops down and say, oh, well, that fund's not doing very well that year. We should sell.
Yes.
So they come back in, they buy a fund that's doing pretty well at the top, and it goes down to the bottom of the pack, and they sell. So they're buying high, and they're selling low. They say, well, now we've got this money. What should we buy? Well, gold is good, or our emerging market's good over here. This is good over here. And they buy that, and a few years later, that one goes down. So they tend to churn their portfolio, buying and selling, and making the wrong picks, as opposed to just staying the course. And over a period of time, if you've got a well-diversified portfolio, it'll do well as long as you're well-diversified. But don't be picking and choosing and timing the markets out there, is the bottom line that Dalbar concludes. And there's all kinds of different years you can look at. This happened to be just this one I picked up here.
Very good. Well, I have just a minute or so left, or 2 minutes. I want to make sure. So before we do end the show today, always great having you on the show. If you could give the listeners, again, a reminder where they could reach you. And again, remember, as you're listening to this podcast, when you reach out to Ron or I, he's good enough to give you a book and any of this information as well. So again, the best place to reach you would be?
Our phone number again at Siena Wealth Management is 408-244-3800. Again, 408-244-3800. And our website, again, as I mentioned, is www.siena, SIENA, wealth.com. And last thought is don't panic. Everything's going to be fine, right? Just keep investing, dollar cost average. I tell people, they say, well, what should we do about this and about that? I said, 15, 20 years from now, it won't make any difference at all whether you invested today or whether you invested 2 weeks ago or you invest a month from now, because it's not going to be that radical of a change in the market. But as time goes on, it becomes like a little blip. But anyway, that's the main thing, is to get invested, get going, and then ride it out. Very good. Well, Ron, thanks again. It's always great having you on the show. We'll have you on sometime later down the road. Thanks again. You bet, Joe. Thank you again. This is Joe Cucchiara with Real Estate Radio Live, our podcast series. Remember, if you want any more information, go to reradiolive.com or contact me at 408-838-9060. Take care.